Intro to Accounting, Mr. Roberts here, and we are almost to the end of this accounting class. We only have Chapter 7 and Chapter 8 left, and they're both pretty small. And everything we do in Chapter 7 is building on from what we did in Chapter 6 with our worksheet that we completed. So today we're going to be preparing an income statement. Our learning objectives is prepare an income statement for a service business and then calculate and analyze financial ratios using some of that income statement amounts. And this is really, really similar to what you're going to be doing in the additional accounting classes that we have at the school, preparing actual financial statements, and even in some other of the business classes, is preparing these specific kinds of financial statements. The income statement, later on the balance sheet, because this is what really helps us understand if our business is being run correctly or not. So it's really, really important. This income statement and all of Chapter 7 is something that you'll use in real life. When I was in operations management, these would be reports that I would use on a normal basis, or reports that are very similar to this. So there's going to be a bunch of information here, right? And there's going to be some terms and everything. I wouldn't say it's too complicated, but you do need to be familiar with what these terms are. And we've talked about accounting being the language of business. And we're getting to the point now where we are making it easier and easier for the people around us or ourselves to start using this information to make decisions. And that's what we're doing in this chapter. And when we report financial information, that's what we're attempting to do, is report the financial information that we've had. We get to the end of an accounting period or an accounting period cycle. Let's say it's at the end of the month. Let's say for some businesses, it's at the end of every 3 months. For some businesses, at the end of every year. And now we're going to report financial information to two different groups of people, I would say. The first one that we're going to look at here is it's going to say the area of accounting that focuses on reporting information to external users. Okay, so external users, people that are outside of our company. When you look at external users, they say it could be bankers, creditors, customers, government agencies, and stockholders. So we're going to give this information that we've recorded through our general ledger and through our worksheet. We're going to compile it together so we can get this information out to the people that care about our business, but they're outside of the realm of our business. I did pull up, here we go. We have Yahoo Finance, and you can see Tesla here. And they have, because they're publicly traded, they have a bunch of information out there, and it's financial information. And I would be an external user of Tesla, right? Because I own a little bit of Tesla stock. So what they're going to report is the financial information of the company. And if we go into financials, what's the first thing that actually pops up is their income statement, the thing that we're going to be creating today. And their income statement is going to have a lot more things than ours is. But really what it comes down to is it's going to be the revenue or the sales. And then it's going to be expenses that are also going to be recorded. And at the end, you're going to get a net income. Okay, so it's revenues, expenses, and then a net income. But I would be an external stakeholder or an external user of the financial information for Tesla. So that would be referred to as financial accounting. Now on the flip side, where we have accounting that's going to focus on internal users, is called managerial accounting. And this information is going to be used for the people that are actually running the business. This is so important, right? Because I want to know how much I spent on my payroll expenses. And I want to make decisions in the future. Do I need to spend more money on payroll? Do I need to spend less money on payroll? How were my sales and my revenues? Do I need to increase my sales next year, and by how much? So this is managers or people that are running your business. That's managerial accounting. So we have financial accounting with external users and managerial accounting with internal users. And they go through a couple different GAAP terms, and they talk about full disclosure or adequate disclosure. What that really means is all financial information must be reported. you can't hide anything. You can't say, all right, I'm going to put in the payroll expenses, but I'm not going to record any rent expense. I'm just not going to do it. No, everything needs to be reported. Think if you were buying this Tesla stock and they were hiding financials from you, right? That's not fair, okay? You need to have adequate disclosure, full disclosure of all of your business's financial condition. And we're going to create two different statements, but for the most part, there's three financial statements that you'll usually create in any kind of accounting class as you move further on. And there's an income statement, a statement of owner's equity, and a balance sheet. So those are going to be the three. Today, we're just looking at the income statement. But if we kind of look here, it gives us the definition of a statement of owner's equity. And this is a financial statement that reports the changes in the capital account for a proprietorship for a period of time is called a statement of owner's equity. So if you think about that, what's our owner's equity? It's the ownership that they have in that business. Well, over time, they could either own more of that business or own less. That's really what it comes down to, okay? So statement of owner's equity is going to be that change, how that change is represented in that company. And then they kind of talk about another term here, and that's the accounting period cycle. So what they're pretty much saying is that these financial statements are going to be created every single time that accounting period cycle takes place. For Mr. Delgado's business, I believe it's going to be the end of every single month. So at the end of every month, we'll create a statement of owner's equity, an income statement, and a balance sheet. There we go. And then they go over another term here, and they kind of hide it in, but this concept is called a going concern. And what a going concern means is that there is the expectation that that business is going to continue to be running and continuing to be in business. So it pretty much says that there's an expectation that the business is going to continue to run indefinitely, meaning Mr. Delgado does not plan on shutting down the business next year, because if that was the case, he could be, he could be messing with the numbers a little bit, or he could be building up the business to then make an exit, and all your external stakeholders or internal stakeholders probably wouldn't be very happy about that. So that's what it's called. It's called a going concern. Like I said, there's a lot of kind of hidden terms in here. And you might have heard me say stakeholders a couple times, and that's what we're looking at here. There's two different things, right? And sometimes they get confusing. But there's stockholders, which are people that own individual stock in a company, right? So if I wanted to buy a little piece of Tesla right now, I would have to pay, this number's changing, you can see I'd have to pay $432 to get one share of stock. And that's called a stockholder. You own a little bit of a company. There's another term though, and that's stakeholders. And this is any person or group who will be affected by an action. And that doesn't just refer to it from a money standpoint. They have an example down here where this is the impact of stakeholders of a motorist's decision to drive without a seatbelt. So you can see here that the stakeholders, there could be multiple ones. It could be the initial motorist, and you can see that there's some negative impacts here. The drivers of other vehicles. Well, how does that work? How if I'm going to be the initial motorist that doesn't wear my seatbelt, how could that affect you? How could that be a stakeholder? How could you be a stakeholder in what I'm actually doing? Well, maybe if I get in an accident and I get injured, insurance rates for everybody is going to go up because I didn't wear my seatbelt. What about my relatives, right? So my mom and dad is actually a stakeholder in my decision to wear a seatbelt, because if I get in an accident and I get hurt, well, they're going to be somebody that's affected. And then, emergency personnel like EMT teams, they would actually be a stakeholder in me wearing my seatbelt, because they're going to have to maybe rush to the site if I wasn't wearing my seatbelt and have to perform something that they wouldn't have normally had to do. So, when we think about this, you could be a stakeholder for Quick Trip gas station in Kaukauna, right? Because if they would go out of business, maybe the next gas station is super far down the road from you, and you don't want to have to drive outside of that, outside of your little zone to fill up your gas tank. It could be as simple as that. So there's usually lots of different stakeholders related to any business, because your customers are a stakeholder, your employees are a stakeholder because you give them that job. Obviously, as an owner, you're a stakeholder in that business. So that's the difference between stakeholders and stockholders. All right, so let's just jump in here to preparing an income statement from our information on a worksheet. Yes, we already wrote down everything that was on our worksheet, right? We went in there and we recorded all the accounts that are on our income statement. And what else did we do? We already calculated out our net income. The thing is, that worksheet is not an official document. Remember, we could write it in pencil, and it's just used for preparation. Now, an income statement, if we look at what we prepared on our worksheet here, is what? It's our sales or our revenues, and then it's all of our expenses. And after that, we're using our revenue and expenses to calculate a net income or a net loss. There's really three big components of this. Our book's going to say 4 because it's going to say heading, but in reality, it's just our revenue, expenses, and our net income or net loss. The heading is the heading. We do that for every financial document. And if we look here, this just gives you the definition, but just simplifying. It's our sales and our expenses, and it's going to tell us if we have a net income or a net loss. That's all that an income statement is. So what we're doing is we're going to take this information from our worksheet and we're going to create our own financial statement with it. All right. So with that, we're about to get into it. They do go through a couple more terms and different things like this, and they pretty much talk about a budget, where it's a financial roadmap for you as an individual or your company to make sure that you're spending and saving your money responsibly. And, we need to follow this because, well, why? Let's just take a look at our income statement, right? Like, what if we didn't have a budget for any of these expenses and we just spent, $1 million on equipment rental? Well, then our net income is going to be a net loss and we're going to lose a bunch of money. So when we look at this, it's just important to plan out kind of how much money we can actually spend. And that's just running any business or running your own personal life responsibly, is having that budget. If you take personal finance, we'll create a budget, an entire budget from scratch. And you can see here a positive balance after total expenses are subtracted from income is called a surplus. It's really similar to what net income would be, having a positive net income. If you have more expenses than you had actual revenue coming in, then you're going to have a deficit. So, if you look at, let's go to, let's use the U.S. national debt clock, right? And if you look at this here, does the U.S. have a surplus or a deficit? Well, the U.S. national debt right now is $27 trillion. So when it comes to looking at our budget for our government, well, we don't do a great job of really budgeting. So we don't want to we want our businesses to run a little bit more efficiently than the government, and we want our real life to run a little bit more efficiently than a government budget would. So you can see, though, a surplus or a deficit depending on if we have more revenues than expenses. All right. So now we're going to go through how to actually create this income statement. First thing we're going to do is we're going to prepare the heading of the income statement. You center the name, so Delgado Web Services first. After that, you just write income statement. And then once you're done with that, you write the date that the report is taking place on. But it's important to remember that you're going to write what you write here is an indication of your fiscal period. So here it says for the month ended January 31st, which means that this information on the income statement is going to record all the information in January. All right. So for month ended January 31st. This will be different depending on the date, obviously. But then when we get into our balance sheet, we won't put 4 month ended, and you'll see why. So that's why I'm pointing it out right now. So there we go. We've made a heading before. We can handle that. And now, this is going to look really complicated. But I'm telling you, that is not as complicated as these 14 steps that we have here. I know you guys can handle this. So as we get into it here, remember, there's these 3 big components: revenues, expenses, and then a net income or a net loss. And one of the things that messes with people a little bit is going to be the fact that there's headers on here, right? There's like category, there's like category, like headers, right? So like revenue is our first header that we have. We write revenue, and then there's nothing that's actually reported across for revenue here, right? Can you see that? There's nothing that's actually being reported there. Why is that? Well, because revenue is going to include our sales, okay? So it's pretty much saying like, okay, here's our category of revenue. What are all the revenues that we have? Well, here we only have sales. So we just record sales, right? It's pretty much always going to be that. What's the revenues that we have? Well, it's our sales. We're a service business. In this case, we only have one account for sales though, and it's just sales. That's all. So we're going to record the amount of sales. And this revenue amount here is $5,820. Now, you can see that there's 2 columns here. A column on the left and a column on the right. The column on the right is going to be for the totals that we have in each kind of little category. So it's the revenue total. It's going to be our expenses total. It's going to be our net income total. That's what goes in that second column. So because sales only has one category, it automatically gets recorded in the total column. So the 5,820 is going to be recorded in the second column here. And there we go. That's the first part of our income statement. Just writing down our revenues, it's sales, we record in the second column. Next, our category is expenses. So we're just going to record expenses, okay? There we go. And let me just scroll down here. I just want to see how they're recording expenses. So they don't tell us exactly how they want us to record expenses. To me, it looks like it's going to be alphabetical. You know, sometimes the book does different things with this, so I just want to make sure. So we're going to list out all of our expenses. And once again, look at expenses. Is there anything written across on expenses? Nothing, right? So you're just leaving that blank. But then we're going to list out all of our expenses. These should be in the same order that's on the worksheet, right? So we list them all out. And do you notice that we list all of our expenses in the first column? Why? Because they're individual accounts that aren't totaled yet, right? So we list all of our expenses on the left-hand side. After that, we're going to draw a single line underneath expenses. Now, you're not going to actually have to do this, but I want you to remember it if you ever do it by hand. And now that we have this, it's a single rule line that's going to show that we're going to add up all of our expenses. So once we list all the expenses, we're going to write total expenses. We're going to total up all of our expenses. And when we write total expenses, what we're going to do is we're going to record this in the second column. Why? Because it's a total. That's why it goes in the right-hand side column. So we add up all of our expenses, we get $2,658. And then from here, we need to calculate out our net income, right? So we need to calculate this out. Let me just pull up a calculator real quick. Okay, so how do we calculate our net income? We're going to take the difference between sales and the difference between total expenses. Now, right now, is there more sales than expenses? Yeah, there is, right? 5,820 in sales, $2,658 in expenses. I know automatically that I'm going to have a net income instead of a net loss. But let's just calculate this. 5,820 minus 2,658. And you can see that our net income is just calculated by finding the difference. So it's going to be 3,162. You can see that they drew another single line here showing that we're going to calculate out our net income. The net income also gets calculated over on the right-hand line, or on the second column as well. Okay, and then you look at the last couple steps. We recorded that net income, and we're also going to rule double lines across both columns to show that the amount has been verified as correct. Now, how can we verify that this amount is correct? We could probably go back to our worksheet and check it, right? Because this is all the information that we had on our worksheet. It's the same thing, okay? It's the exact same thing. So there we go. That's our income statement. And you're going to be putting these together on your own, so it'll be you'll get a little practice at it. Now, this part catches some people off guard a little bit, okay? And we talk about this. We talk about accounting being the language of business and using these statements to make financial decisions. And what we're doing here is we're making it even easier. We're making it even easier for people to understand what these numbers actually represent and how we are doing when it comes to our net income compared to other businesses. So what we're going to do is we are going to create some financial ratios. This is a comparison between two components of our income statement. So it says the calculation and interpretation of a financial ratio is called ratio analysis. So we're going to calculate out a financial ratio, and then after that, we're going to look at that ratio and say this is good or bad, and that's considered ratio analysis. And when it comes to an income statement, what we compare everything to is sales. So when you look at this income statement here, what we're going to do is we're going to do a vertical analysis is what they call it, meaning up and down. We are going to put percentages and record financial ratios. But everything is compared to sales. So here, when we have this revenue of sales, it literally says percent of sales. What percent of sales is our sales? 100%, okay? It's 100%. So when we look at this, we don't have to do any calculation. It's just what percent of sales is sales? It's 100%. Every other financial ratio is compared to sales. So here they're looking at the total expenses compared to sales. Let's go over to our calculator and figure out how the heck we're doing that, right? Well, what we're going to do is we're going to take the expenses, 2,658, and we're going to divide them into the total sales, 5,820. And what do we get? We get 0.4567, right? Well, what we're going to do here is we're just going to times that by 100, and you can see that we get 45.67. We're just going to round that up to a single decimal point, right? So 45.7 here. That's what it's going to be because, 7 here is above 5, so 45.7. And you can see that our total expenses compared to our sales is 45.7. And at this point, we would look at that and go, is that good for our specific business? And this is a number that you could compare to other businesses. You could compare it from one month to the next, right? It's something that we could use in the future. When it comes to the net income, you're doing the same thing. Let's take the 3,162 and divide it by the total sales of 5,820. We get 0.5432. We're going to times that by 100, and we get 54.3. And you're just going to write this in this column here, okay? And this is called a vertical analysis. Yeah, and sometimes when we look at this, this is our net income ratio. This is a pretty important number, right? If you're running a business, you should probably know, like, if I'm running a website service, there's going to be kind of like benchmarks for all the businesses that are website services. And it's going to tell you, like, hey, you want a 52% net income financial ratio to your sales. And you're going to actually try to reach that, right? So here's the net income ratio. It says for businesses similar to Delgado Web, an acceptable net income ratio is not less than 52%. Okay, so therefore, Delgado Web Service ratio 54.3 is greater than 52% and is acceptable. The ratio of net income to total sales is going to be called our return on sales, because essentially what that means is that every single dollar that we get in sales, we get to keep 54.3 cents of it, right? That's what we get to hold on to and keep in our business. So that number is really, really important. All right, a lot of fancy terms, but the actual steps in completing it, not too bad. And then they throw another thing at us here, okay? And this right here is going to be our income statement. And what if we have two sources of revenue instead of one? What does that look like? And then on top of that, what if we had a net loss? So let's pull this up, and it's all the same, except if we go over here, what would we do if we had two different revenues? Well, now that we have two different revenues, let's say this is a looks like it's a company that's selling lawnmowers, and they wanted to separate the riding lawnmowers versus push mowers to see how their business is doing. Well, they have two different types of sales. Now we're going to record sales in this first column, okay? Because it's not the total number. And all we're going to do is we're going to add total revenue, just like we did with total expenses, because now we have two sales accounts. So now we'd add total revenue, and our total revenue would be recorded on that right-hand side, on the second column, which is $21,200. Okay, so that's the only difference. When it comes to the net loss, if we looked at this, we had $21,200 in revenue, and if we look at our total expenses, it's $24,127. What does that tell us? It tells us that our company now has a net loss. So over here on the left, instead of writing net income, we're going to now record net loss. And our net loss is going to be written down in parentheses to emphasize that it is a negative number. So what does that do for our financial ratios? Well, if we look over here, our total expenses actually has a financial ratio that's more than sales. Now, does that make sense? Absolutely it does, because everything is always compared to sales. So right now, our expenses are 113.8% to our sales. So how would we calculate that? Same way that we did it before, 24,127 divided by 21,200, and we get 1.138. We multiply that by 100, and we get 113.8. Now, this is a positive number because it's 113.8% above our sales. When it comes to net loss, this is going to be a negative number, okay? So we're going to need to put this in parentheses, but we really do it the same way. 2927 divided by 21,200, and we get 13.8. We'll times it by 100, and it's 13.8. Okay. Now, if I did a negative, I don't know what's this going to end up being, but negative 2927 divided by 21,200. Yeah, then it's just a negative 13.8. So you could put this number in as a negative and divide it, and it'll show you that it's a negative percentage. For me, when I see that it's a net loss, I automatically know that it's going to be a negative number. So I don't ever enter it in as negative numbers when I'm recording it. Totally up to you though, okay? It's kind of preference. So there we go. That's what we do when we have multiple revenues, and then what we do when we have a net loss. Now, do we want to have a net loss for our company? Absolutely not, right? That's not fun. But it happens, and we got to record it. So let's jump in to the 7-1. You will have to do the terms review here. Let me just make it graded real quick for you. Just make that graded. So make sure you do the terms review. We'll hide that. You don't need to audit your understanding. So let's jump into the working paper 7-1. And here we go. Let's move this over a little bit. Okay. Income statement heading. Remember, there's 3 parts to the heading. Hair Care Salon has completed its worksheet. It is now ready to prepare the income statement. The first step in preparing an income statement is the heading. Fill in the blanks for each row of the income statement heading. Enter the current year as 20 --. So we have Hair Care Salon. After that, we're going to write an income statement. And now, this is important, we're going to put for the month, or for month ended. It looks like it's May 31st. 20XX, or how they do it, --. There we go. It's grade step 1. Good to go. All right, so now it says the list of accounts shown here is taken from the Hair Care Salon worksheet. For each account that appears on the income statement, indicate the section in which it should appear. For any account that does not appear on the income statement, select neither. So remember, income statement is revenues and expenses. That is it, okay? That's all. So cash is an asset, petty cash is an asset, supplies is an asset, prepaid insurance is an asset, accounts payable is a liability, Candace Power Capital is a equity, drawing is an equity, income summary is going to be neither. That's a temporary account that we'll look at chapter 7 or 8, can't remember. Sales, hey, that's a revenue, okay? This one's going to go on our income statement, and then we have all of these expenses. So it's just sales and expenses. There we go. So next it says use the worksheet of Hair Care Salon to prepare the body of the income statement for the month ended May 31st of the current year. So now we are just going to record our sales and expenses. And where do we get that information? Well, we're going to get it right from our worksheet. All right, let's see if it works. Oh, it did. We're rocking and rolling. Rocking and rolling. Okay, where we're going to look, remember, we have our trial balance, and then we made adjustments. And we made adjustments to things like supplies expense and insurance expense. So you can't use your trial balance. You actually have to go over to the income statement, right? That's what we're going to have to use over here. So let's go over to the income statement and take a look at some of these. The first one that we have on our income statement is sales of $5,800. So let's put in $5,800 for our sales. Now we have advertising expense. Remember, you're looking at your income statement here, which is $750. We have our cash short and over of $3. Our insurance expense of $610. And if you looked on the trial balance, you see that has a zero balance right here, right? So we do need to, you kind of need to remember that and be like, oh yeah, I've made an adjustment, so I must go to my income statement and transfer these numbers over. So just so you don't forget it. Miscellaneous expense was $167. Supplies expense was $540. And then utilities expense was $300. So let's go ahead and add those numbers up. Ooh, it's there. All right. Let's go ahead and add them up. 750 plus 3 plus 610 plus 167 plus 540 plus 300. We got 2370. Now, the thing is, I just added all this up. I can throw in 2370. Woohoo, we're awesome. But there's always somewhere that we can check because we've already done this on our worksheet. So if we look here, you can see in the debit column of our income statement, we're only listing all the expenses. So we've totaled this up already, and you can see here it's 2370. Does my 2370 match the 2370 there? Yes, it does. Okay, so we should be good to go. As long as I didn't type something in wrong again. And we are okay. So let's move on to the next step. Calculate out a net income or a net loss. Oh, whoops. Calculate out a net income or a net loss. A net loss is entered as a negative number. So right away, do we have more sales or do we have more expenses? We have more sales. So we can go ahead and we can take the 5,800, subtract the expenses of 2,370, we get 3,430. And what is this? This is a net income, right? This is a net income. Now, if I went back to my income statement amount and looked at my trial balance, we've already calculated this as well. So we could use that to check it. But we're just going to trust it, and we are good to go. Let's look at the last step that we have, and now we're going to do a vertical analysis and create some of these financial ratios. So when we look at sales, we're always comparing everything to sales. You can even see it. There's a nice friendly reminder, percent of sales. Well, the sales here only has one column, and what's the percent of sales of sales? Well, it's 100%, okay? So we're just going to put in 100%. Now we have our total expenses. So let's go ahead and calculate that out by taking our total expenses of 2,370 and dividing it into our sales of 5,800. Okay, so we have 0.4086. We're going to multiply that by 100, and it should be 40.86. Now we're going to round this to the nearest 0.1, so I'm thinking this is actually going to be 40.9, okay, because the 6 is going to round that up. So let's do 40.9. And then down here, we're going to take our we're going to take our net income of 3,430, and we're going to divide it into our sales of 5,800. Why do I keep putting the 2 there? 5,800. And we have 0.5913. Let's multiply that by 100. And it looks like it's going to be 59.1. Let's go 59.1. And let's grade this final step. And we are good to go. So we've used the trial balance, and we've recorded all of our revenues and our expenses. We've totaled that up. We've calculated out if we have a net income or a net loss, and then we've done a vertical analysis after that. If we continue on a little bit here, and you see that the on your own is going to be the same thing, make sure that you're looking for a net loss as well when you're going through that, okay? And then let's just look at the application problem, make sure it's the same. I'm pretty positive it is, but it's asking you to do the exact same stuff, okay? So just a good amount of practice as we continue going through this unit. So that is 8.1. It's an income statement, right? If you have any questions, please let me know. Thanks.